Howdy, Jacob here. Today we're looking at Acuity Brands in the electrical equipment industry. Looks like they provide lighting and controls, building management system, location-aware applications, U.S. and internationally. So 8 billion market cap, pretty substantial. Growth is pretty impressive. You're looking at high single-digit compound annual growth rate with increase in gross margin, operating margin relatively flat, and by golly, that is consistent. Holy smokes. So operating margin from 2018 to 2023, if you exclude COVID, 12.5 to 12.7%, 5 of the last 6 years. That is wildly impressive on a different level. I think that might be the most consistent operating margin I've ever seen. So pretty wild there. Return on invested capital, pretty impressive, low teens. And they pay a dividend, haven't increased that in the last 10 years, but still pay it. That yield is 0.2%, so sometimes I wonder why they pay it. Beside the point. Balance sheet, $398 million cash on hand, $496 million long-term debt. I mean, that's $100 million net debt, $98 million left over of their debt, and they make way more than that in a year. So we're not concerned with the balance sheet at all. It's a very healthy balance sheet. Cash flow. Great cash flow production, slight increase in capital expenditures due to their acquisitions, it looks like. Not a whole lot of reinvestment back in themselves, and a heavy amount of share repurchases. So that dividend pays out maybe, that is nothing. That is 5% of their 5-year average free cash flow, so very little. Share repurchases, however, are a huge amount. You're probably looking at maybe 70% of their 5-year average free cash flow. Acquisition, maybe 10, 15%. So a very heavy majority of their free cash flow is going to share repurchases. And we do see their shares going down quite a bit. So let's start with some assumptions here. So revenue growth side, what are we thinking? I mean, probably I could be pretty comfortable jumping on board with maybe 6% and pretty solid PE price free cash flow. Let's put it at a slight premium at the end of 7 years to the market. 9, 11. Let's just do that. 9 on the earnings side, 11% on the margin side, and for share repurchases. Dividend good there, keeping that. That's fine. They actually increased it from 52 cents, so good for them. But still, we haven't seen a whole lot of dividend increases, so I'll assume that keeps the same. Let's say it's 5% of their free cash flow. Let's put a heavy majority on the share repurchases. So 1% is about 80 million. That means 3% would be about 240 million, 280 million to offset stock-based compensation. That's a heavy amount, but I think is fairly reasonable for them. So this is assuming 75% of their free cash flow is going towards share repurchases, maybe 5% to dividend, and then that remaining 20% to get this type of growth through reinvestment and through acquisition. And we're saying it needs to fall 44% to get to the return we're looking for. I think this is absolutely a company I want to own. The numbers are looking great. Very light on the balance sheet, which is awesome. And very good returns on invested capital, well above their weighted average cost of capital. But for me right now, we're just not quite at the price, but honestly, probably not too far off until I do deeper dive here. So I do hope you enjoy the video, do your analysis, and review the company, and have a great rest of your day. Thank you.